Our next guest correctly forecast the major instability taking place in Venezuela. It all began with the country's outdated water infrastructure and severe drought, and could spread to Venezuela's oil industry. In fact, it already has begun to spread. Colin Fenton is CEO of Curium Capital Advisors. He's back to tell us whether this is enough to send oil back to triple digits. That would be quite exciting if in fact it happened. Colin, as I say, you made this prediction back in October. It has proved correct. People are catching up to the idea that part of Venezuela's instability has to do with drought. It has to do with energy and oil refining. Explain where this goes next.
Well, good morning, Eric. Yeah, this is severe enough that it could send oil to over $100 and gasoline to $4 per gallon. Basically, there have been 5 developments in the past month that we would emphasize. The first, in an emphasis on how much stress this is putting on Chavez. His first response was to try to rename the highest waterfall in the world from Angels Falls to its indigenous name. On January 8th, he devalued the currency by 20 to 100% against several official exchange rates. Since Christmas, in a third aspect, he's cut production at the largest steel mill in the country by 50% and has cut some of the aluminum smelters by more than 30%. Last week, the National Petrochemical Company was hit. It's now cutting production of fertilizers and pesticides. And he also, last week, attempted to put in a rationing program in Caracas. It was so disorganized, so disorderly, it was canceled in less than 1 day. He then sacked his electricity minister, who had been on the job for 2 months. And then finally, 2 days ago, he expropriated the French hypermarket chain Éxito, and it's just clear he's under enormous stress.
No question. Let's quickly take a macro view on this. What do you think this does to Chavez? Obviously, these issues, all of which you described, are a big deal in Venezuela, but how could the energy crisis affect his presidency?
Well, the dry season will remain in effect until May, so what he is going to have to decide every single day is what to do with Paraguana. This is the only part of the puzzle that remains left to be decided. It is the largest oil refinery complex in the world. It is the only remaining spare source of power in the country, and so the choice he faces is whether to divert power from this oil refinery to the people who are thirsty and frustrated with his management. If he does it, it would be sufficient to send oil prices significantly higher. It's a major threat for equities. And our sense is that most policymakers and investors really are still not paying attention to this story. It's probably going to be one of the top 5 stories of 2010 for investors. As
such, we're going to have to come back and talk to you about that later, but I do want to make a quick transition to something else that's caught your attention. I know there are a lot of things, but the one that's caught mine, let's say, is natural gas. Your view on natural gas and how to play it this year. Tell us what you're thinking.
Okay, so in the past month, French oil company Total acquired a substantial portion of Chesapeake's unconventional gas assets. Exxon announced that it would acquire XTO. That acquisition comfortably puts its provable reserves above 50% natural gas, meaning that the most famous oil company in the world is now actually a natural gas company. That's important because our sense is that investors are looking at these 2 corporate actions, and even some of the news with Williams today, and are making a bet on natural gas futures. I think that could be a mistake. I would really prefer the equity here over the commodity. Let's not forget that since the foundation of Exxon's predecessor company, Standard Oil, the emphasis has always been on profit margin, not price. So to have such an important company really enter the natural gas business in a major way, even more than it already has, could put a lot of pressure on price. Just to give you one set of numbers, natural gas F&D costs at Exxon are in the range of $3.40 per MMBTU. If you look at your screen, the price of natural gas in the spot market is about $5.60, and if you look at the futures, they're at about $6.85. Moreover, the only thing that is really keeping natural gas prices where they are today is a government restriction on accessing enormous supplies in the Gulf of Mexico, the outer continental shelf on the coast, and also in the Arctic.
Colin,
about 18 months ago,
I'm afraid we got to wrap it up. Colin, we'll have you back soon. That's Colin Fenton, CEO of Curium Capital Advisors. Thanks for joining us.